All right, welcome, guys. Let me know if you can hear me okay. Just in the comments, please. Welcome. All right, welcome. All right, so before we get started, I just wanted to uh, give an update on Numbnuts today, who is on Instagram impersonating me, trying to sell crypto trading packages to people. And you know what? One thing that I do love about YouTube and Instagram is the fact that one thing I have realized is that people who do actually follow and pay attention to the channel will actually go out of their own way to go and find out about stuff like this. And that's what I've had today. So in the rundown, it turns out that this kid, whoever he is based in the Philippines. He clearly doesn't really know what he's talking about because if you go onto my Instagram stories, there is a screenshot that one of my followers has sent me this afternoon. He actually managed to bait him onto a video call. And on Instagram, that is, by the way, guys. And what he's basically trying to sell people, he has a screenshot where he was showing tickers for stock equities. So AMC was in there. He doesn't even know the difference between crypto and stocks. So the kid really doesn't know what he's talking about. There is some further investigation around what they're actually looking to put you into. And I'm just going to show you very quickly my screen so that we can kind of get a status as to where he is at the moment with regards to the account and actual growth. I'm also going to share with you what I found out is his strategy. So this is the account on Instagram right now that is pretending to be me. Notice, guys, there are two R's. Yesterday, he had two T's. So what he will likely do is he will basically go to two S's, two A's, two M's, two N's to try and keep this up. Yesterday, that count was around about 300 or so. So what he's effectively doing is he's following everyone that is following my legitimate account, and he's messaging people individually. Now, if you do follow me on Instagram, it goes without saying that I would not send you a DM directly asking you to sign up to any trading platform of any kind. This is where they're basically trying to get people to go to. I had a good chat with him this afternoon. And then he's also sent me onto this one right here. So look at this. I'm not being funny, and I'm going to be really bold and just crass in saying this, guys. But if you send this guy 500 quid, 5,000 pounds, or any money, then I'm sorry, you're an idiot. Okay? Especially if you think that I'm the one who's put you onto this. So be careful. I'm just showing you this so it's on record. I know that a lot of people have actually messaged me on IG, and I've seen some comments on YouTube over the last day or so, particularly today, people saying, I thought you were a good guy. I got this message on Instagram, and, I did have a look at your stories. I found out it wasn't you, but you need to be mindful of this. You do need to be very, very vigilant, guys. So make sure that you're not sending this shyster, whoever he is, any money. And if you do get to speak to him, look for the simple things that are obvious. He is a Filipino guy who tried to put on an American accent. You know what my voice sounds like. So if it doesn't sound like me, then you should know that it's not me that you're speaking to. And I don't have a team of people that have a trading floor. I don't have any partnerships with anybody with a trading floor around Forex or cryptocurrencies or anything like that. So please be vigilant. That is the update for today. But I do want to talk a little bit about index funds, because index funds are a means that plenty of people are using to invest right now. There's nothing wrong with them at all. However, there is one big issue with them that I wanted to talk about that is related to what we were talking about yesterday in regards to where the markets are and the fact that there's going to be a ton of volatility moving forward. So as you guys probably know from watching a load of YouTube videos, passive funds, index funds are great because number one, they are low cost. And number two, they have the ability for you to invest into the stock market and get massive saturation. It's actually one of the things that I like about them. And it's one of the things that I always kind of say to people, look, if you're going to start anywhere, you're better off starting with a fund. An index fund is a great way for you to start. However, there is one key thing that you need to be mindful of. And I've spoken about this a number of times on YouTube here, and certainly on the live Q&As that I do here, and IGTV lives. And that is the notion that one of the big narratives that has been pushed and perpetuated through social media is you should look at index funds because they are cheap. And my narrative has always been, do not go into investing with looking for the cheapest option being your number one priority. That is not how you should go about deciding who you should use, what platforms you should use, or the manner in which you should invest. There are so many things that come before that. Cost is just one of the considerations. And unfortunately, all over YouTube and all over social media, people have been telling you invest in index funds, invest in index funds because they are cheap. They're the cheapest on the market. You want cheap, 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 cheap. That's not always the case. And what we're facing right now is a prime example of why cheap is not always best. So, index funds. Let me just go over what an index fund essentially is. So, an index fund will basically allow you. I'm not taking questions, guys, on these live sessions. An index fund will essentially allow you to invest in a market and gain saturation across that market. So, for example, if you're looking at the S&P 500, for example, you get to invest money into the S&P 500, and you get to invest money into all of the companies that are in the S&P 500, so 500 plus companies. And what that essentially means is that you start to capture companies that are spread across different sectors. So you will have tech, you will have financials, you will have telecoms, you will have things like consumables, you'll have renewable energy, a multitude of sectors. And what that essentially means is that from an investment portfolio point of view, you manage to get your money saturated and diversified across a number of different companies and a number of different sectors. If you do this on a global perspective, you also then get the global diversification as well. So, meaning you get exposure to the US market, you get exposure to the UK market, to the European market, to the Japanese market, to the Chinese market. You get the drift, right? You get global diversification across different economic areas and across different sectors. Index funds are great for those. It's like buying a box of Quality Streets. You actually get to own all of the suites within that box. Great. Now, with an index fund, typically all of them, most of them, majority of them are passive in nature. And if you don't know what that means, this is what it means. A passive investment is essentially one that will track the performance of the market it is set to track, essentially, right? It will mimic the performance. And this is great in rising markets. So, for example, if you're tracking the S&P 500 and the S&P 500 has a 50% year, then your passive index fund is fantastic. It's great for that purpose because you should see that your performance will mimic the performance of that index, the S&P 500, that year. So you're going to get 50% or close to 50%, depending on how closely it tracks performance in line with the performance of the S&P 500. That's a passive investment. A passive investment means it's mimicking, it's tracking. There is no intervention. There is nobody behind the scenes checking to see what's going on with the individual companies that you're invested in, to see whether there is volatility, measuring volatility, making moves or making decisions that could hopefully benefit your portfolio. Passive funds are fine in rising markets. Okay? Rising markets, passive funds are fine. And this is where it frustrates me because we have so many people on YouTube talking about investments. Investments is not their area of expertise. They have another profession. They're talking about investments, and that's not calling shade at anybody, but nuance is important. Detail is important. Context is important. Practicality is important. People are always talking about passive investment because it's cheap. Cheap is not always best. Cheap is not best when you encounter a falling market. And if you are a first-time investor, the big question you have to ask yourself is, and again, these come back to considerations. If the markets were to fall 40, 50%, even 10%, 15%, are you happy for your investment to simply track the downward trajectory of the market? Or would you prefer to have professionals interject and intervene, rebalance your portfolio, and seek out new opportunities based on how the market sits at that point in time? Which would you prefer? For many people, they will prefer the former. For many people, the latter sounds more attractive now because you didn't know that actually you could have someone in the background making decisions. I'm going to give you a prime example of that. As you guys know, I've got money all over the place across all of the apps that I've pretty much reviewed on this channel. So that's Trading 212, Free Trade, that's Money Farm, that's Fineco, Hargreaves Lansdown. I've got money with most of these providers. Okay. Last week, I got a message from Money Farm. Money Farm are an active investment manager. So they manage your money on an active basis. They rebalanced my portfolio last week based on the circumstances at hand. So when things were really volatile last week, they did all of that for me. They rebalanced my portfolio and they've reset the portfolio based on the circumstances right now. If I go onto my Money Farm app, and this is not an ad, they're not paying me to say this, but I do have my money with them and they have sponsored this channel before. Let me just log in because I've got a new phone. I've got the new iPhone 12 now. It just arrived yesterday. Let me just try this again. I think I know what I did wrong there. It's up at the moment. My portfolio is up in the face of all of this volatility. I checked it yesterday, it's up 5%. Okay. And that's because they run an active management service. That means that when markets get really, really choppy like they are right now, they intervene. They look at what's going on and they decide, right, for our clients right now, we feel as though maybe selling this company might be a better way, or we're going to reduce their exposure from equities. We're going to put them into bonds, or we're going to go from bonds. We're going to go out of bonds straight into equity. You have professionals that are there pulling the strings, assessing the circumstances, assessing the climate, and making investment decisions on your behalf. So my portfolio in Money Farm right now is actually up. It's down slightly right now today, 3.48%. Okay? Now, that's the benefit of having active management. And the question you need to ask yourself is this. If you're a first-time investor who has been watching YouTube channels and you've gone with a passive fund purely because everyone's told you it's cheap, you need to keep your costs down. And there is an argument for that. I'll talk about that in a moment. And now you're feeling a little bit nervous and you've discounted professional investment companies like Money Farm, or who else does active management. I believe Nutmeg also do active management as well. With Nutmeg, you've got to pick, I think it's their JP Morgan or their fully managed one. Those are actively managed. They've got two that are not. Again, I'm not being sponsored to say this, guys, right? But if you have discounted any of the providers that would have done this for you on your behalf, looked after your money on your behalf with an active approach, and you're feeling nervous right now, then maybe, just maybe, you need to go back to the drawing board and reconsider where you are. Because if we look forward, things are going to continue to be volatile. And this raises the question again of, if you are doing this on your own, are you really equipped to do this on your own properly? Because if you are invested in an index fund that is passively managed, and let's just say the markets go down 10% tomorrow, what are you going to do? Number one, are you going to be able to catch it? Number two, will you know what to do? Number three, will you learn too late that it's gone down 10%? Now, most of these professional investment houses, so Money Farm, Wealthify, Nutmeg, all these players that charge a little bit extra that you've been told to stay away from because they charge you extra, they will have something called a 10% loss procedure that they have to go through, which means that if the market falls by 10% on any given day, they have to take action. Can you take action as an individual investor doing this on your own? Probably not. You're paying them a fee to do a particular job for you. The unfortunate thing is, on social media these days, just for clicks and views, people will tell you this is the cheapest one you should go for. And they lead with that because that is the most important thing in their mind, without really knowing, having worked in the industry or having any experience at all of the investment world. They'll tell you it's the cheapest one because they know that's what you're going to click on when you're watching videos. But they're not highlighting, by the way, if you go down this route, which is another viable route that many people actually should be taking, but don't because they've been told that cheap, 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 cheap. Because they don't go down that route of active management and it's not been explained to them, they don't understand what they're getting for their money. So again, if you're looking at your portfolio right now, you're doing it on your own and you're really, really nervous, maybe worthwhile going back to the drawing board. Go and watch the live that I did yesterday. I talked about getting back to basics. First and foremost, you need to understand what your goal is. Do you have strong controls over your money? Have you got an emergency fund? After you've done that, then you need to take stock and ask yourself the question and really honestly, are you equipped? Are you personally equipped to be able to manage your money yourself? Really? Are you really personally equipped to be able to do that? Now, if you're using the likes of Vanguard, they are passive funds. Well, they do have within the index fund category some actively managed index funds as well. So you may be of the mind that actually after listening to this, go and do some research and decide whether you would prefer an active fund as well. Now, with Vanguard, you're going to pay a little bit more in terms of the fee. I was looking at something earlier today. I think on some of the index funds, roughly between 0.14 and 0.23, 0.28 for an active index fund for the range that they have there currently, I think is about 0.48%. But it means that you have a team of people behind you who are actually going to intervene should you ever need it, because they're looking at data, looking at news, looking at things that you won't really know or understand fully. So if you are with Vanguard, if you've been using Vanguard, I would encourage you, go back to your basics, watch the live yesterday, then ask yourself the question that I just asked you to ask. Are you equipped to manage this yourself? Making a switch to an active fund in Vanguard shouldn't really be too difficult. If you are buying individual stocks, then you really, really need to sit tight right now. Hopefully you've done your research. Hopefully you're not selling your holdings. Hopefully you're not just cashing out because you're panicking. Hopefully. Okay? Hopefully. I was looking at my portfolio today, and I think yesterday I had 13 stocks down out of 15 in my tech portfolio. Today I've got 5. So this is how volatile things are. How can you go from 13 stocks down to 5 down? Like within the space of 24 hours, by the way, guys. One business trading day. It's extremely volatile. If you're a first-time investor thinking you can come straight into this and manage this all on your own with no help, no research, no nothing, then you're going to be in for a rude awakening, because this is the kind of stuff that is going to become normal and you have to get used to it. So if you're in passive funds right now, I hope hope it's a little bit clearer how passive funds actually work. It's not about the cost. It's about what you're getting for what you're paying for. If you're happy for it to just track the market and you're investing long term, then sweet, you don't have to do anything at all. As long as you're happy with the fact that if the S&P 500 goes down 50% and you're invested in the S&P 500, your passive fund is going to drop 50%. I'm not saying that's going to happen. That's a hypothetical, and that's a bit of an exaggerated hypothetical, but you get my drift, okay? If you're the kind of person who's a little bit nervous and you're thinking, hang on a second, I don't like the idea of something just falling at whatever rate it falls, I would feel more comfortable having a team of people looking at it, monitoring it for me, who have the expertise and the know-how and the research and all of the inside data. Then you should really be considering active management, active funds, active index funds of some kind to ensure that you are able to keep abreast with what's going on. Okay? So I hope that makes sense, because I think this is a really big problem with passive funds at this current time. And because we're walking into a period of volatility where things are likely going to continue as they are right now, and may even possibly get a little bit worse, it's really, really important that you're aware of how a passive fund is going to behave in these kind of environments, because at the end of the day, if you do see the volatility moving up and down and you're not comfortable with it, there are other things that you can do. Now, going to an active fund doesn't mean that you're not going to see that volatility. What it should mean is because you're having people intervene and actually make choices on your behalf, it shouldn't fall anywhere near as much. The volatility should be anywhere near as severe. It will give you a little bit of a cushion, and that can be a good thing, because in a down market, when the market really does kind of crash, what you find is that with active management, because they typically intervene a lot earlier, you have a higher base from which to recover than if you were in a passive fund. So, for example, right, and this is again an exaggerated example, if the market were to drop 50% tomorrow, I could almost guarantee you that active managers, the good ones, will intervene and stop that loss for you. And I don't know where they would. Some of them might catch it at 50%, 15%. Some might catch it at 30%. But the point is, if the market falls 50%, the likelihood is they'll probably catch it somewhere at a more manageable or acceptable rate. I mean, there isn't really any acceptable loss, but you get what I'm saying. If it's going to drop 50% and they catch it at 30, then that's a good thing. It means that actually on the downside, it saved you 30% potentially. And what that means is when the markets start to increase in value, you're not recovering your losses from a lower base. You need to recover it from a higher base. So you have that skill, that input to hopefully smooth out your journey so that it's not as bumpy, it's not as volatile as it would be potentially if you're in a passive fund specifically. So I hope that has been helpful. I've got to jump onto another call in about 9 minutes time, but I wanted to do this live because I think it's really, really important that you guys are aware of this, and it seems to me that these kind of things are a bit more interactive. Sorry I can't take any questions. I know there are a ton of you in the comments, and I'm looking at some of these right now. I just don't have time to take the questions, unfortunately. But look, just be aware of that. And look, I would encourage you, if you are nervous right now as an investor, go and do some research, go and do some reading. If you're using Vanguard, if you're using Fidelity, if you're using whoever it is that you're using, if you're nervous and you're really worried, then I would seriously be asking questions about what active management funds or range or capabilities that they have available that you might be able to access. The good news is that, with all of these providers, when you make a decision, it's not final. So, for example, if you started out with Vanguard in a managed fund or actively managed index fund, you can go from an actively managed index fund to a passive later on. So even if you changed from passive to active right now, and you thought, okay, you know what, if markets recovered, then I might go back into passive. You can still change your mind. Okay, your initial decision is never actually going to be final. Now, the only caveat to this not being completely relevant is if you are investing for the long term and you don't care about the volatility. You've managed to wire your brain, and I talk about this a lot in the course. And again, guys, you guys ask me a ton of questions, oftentimes the same questions over and over again. The course has pretty much all of the basic knowledge and answers to all the basic questions that you ask me, all within there. You can take it as many times as you want. You get lifetime access. There are tests and assessments in there to help you consolidate your knowledge. There's a lot of stuff in there that is going to help you. It is $59.99. If you're going to invest time, I mean, how many of you read Google and watch videos and spend hours and hours and hours watching YouTube videos to try and gain the knowledge, and you're getting little snippets of knowledge that aren't linear in fashion? So they don't necessarily get you from A to B in the quickest time. What it does, though, it takes you from here all the way up here, then down, then it gets you to B after about 3 hours watching videos. The course is 94 minutes long. It will take you for all the way through keeping your money safe, making sure that you can spot scams. Give you a checklist. It will take you through the investor psychology. It will take you through investment timeline theory. It will take you through risk management. It will take you through asset allocation, asset classes, picking funds, how to investing in funds, investing in stocks, individual stocks specifically, what you need to consider. It will talk about all of the tax and how you've got tax allowances. It outlines all of your tax allowances, all for $59.99. Now, I don't talk a lot about what I do and what I offer, but if you are serious about trying to invest and you don't understand the basics, you feel like, I think I'm okay, but you're not really too sure, then invest in $59.99 and 94 minutes of your time is your money at the end of the day. You need to make the right decisions for you. So I would strongly encourage you, if you've not taken it, go take it, because as we go through the channel and the channel gets bigger and bigger and bigger, I will do Q&As, but I won't be able to answer all of your questions. And I will do more live sessions like this where I will not be taking any questions at all. And as comments and everything start to build on the channel, it's becoming harder and harder and harder for me to kind of manage. So the resource is there for you to use. I built it for you to use. So make sure that you use it if you want to. No one's holding the gun to your head at the end of the day. If you want to watch videos on YouTube, then absolutely watch videos on YouTube. That's absolutely fine. But guys, thanks for dialing into this. I've got to duck out. I've got 5 minutes to get ready for my next live on IG. It's not investment related. It's Spotlight Fit 15, which is something that I do with my friend Polina, and we talk about personal development, so on and so forth. We talk about interesting topics. So if you follow me on IG, you want to come and tune into that, we'll be on in about 4 minutes time. But guys, I appreciate you. Thank you so much. I'll see you on the video on Friday. We're going to be doing an update to the Trader v Trader challenge in conjunction with Stake. I'm going to be taking you through those 15 stocks. Oh my God, it's been a nightmare. But anyway, catch you later on.